now is a great time to be planning for any tax-related financial strategies. Right now, we're looking at withdrawal strategies. We're looking at Roth conversions. We're looking at withholdings on required minimum distributions. There's a lot of stuff that can happen during this sort of downtime that we have these summer months, where we do the little things to make sure that you're compliant with your tax strategy and with your meeting what you need to meet in order to not incur any penalties. So you want to be paying your estimated taxes if you have them. You want to be taking your required minimum distributions. Roth conversions is a great time to do that now, and they sort of all pile up in this October, November, December timeframe, because the more information you have throughout the year to make these decisions, the better off you're going to be to make the actual correct decisions. So a lot of these decisions that we make are based on projections of what your tax liability will look like at the end of the year. And so to project what that looks like on January 31st is a lot harder than projecting what it looks like on October 31st, because we have 10 months of information as opposed to 1 month of information. So a lot of it happens towards the end of the year, which is, it creates a artificial deadline. It creates, a lot of a bunching of work, but it's really good to do it now, just because, the more accurate we can be with our projections or recommendations. So required minimum distributions is an interesting one, because the exact amount you have to take at the end of the previous year. So we're in 2026. The amount for 2026 is based on 12/31/2025 information. So we know the amount we have to take. But there's some interesting things you can do with a required minimum distribution. Number one, you can withhold taxes from it. So that may keep you from paying estimated taxes, and you can just do your withholding through your required minimum distribution. All right, so that's just sort of a mechanical thing. Number two, there's ways to avoid paying taxes on that money if you give it to a charity. So you can do what's called a qualified charitable distribution. If you take your RMD amount and you send it directly to a charity, it doesn't show up on your tax return. And that is a better thing to do than taking the money out, putting it on your tax return, and then giving it to a charity. So if you take a required minimum distribution, if you take money out of your IRA, that shows up typically on your tax return as income, okay? And when you file your tax return, you have income, and then you have deductions. And your deductions, from a simple standpoint, can either be one large amount called a standard deduction, or you can itemize if you're higher than your standard deduction. In order to itemize your deductions, you have to have some expenses that you've paid to get above the standard deduction. And some of those expenses are like interest, taxes, medical expenses, and charity is one of those. So let's just say, for example, you take your RMD and it's $100,000, and your state income taxes are $5,000, and your real estate taxes are $5,000, and those are your only deductions. You would take your standard deduction. In that same scenario, if you had $10,000 of itemized deductions and your standard deduction is $31,000, and you have a $5,000 charitable contribution that just came out of cash, you would receive zero benefit from that, because it goes on your itemized deductions, which are now $15,000, and your standard deduction is still $31,000, so you still use that. There's no benefit. Whereas if you send the money directly from your IRA to the charity, it never shows up on your tax return. So something like that, sending $10,000 directly to a charity, could potentially save you, I don't know, $1,500, $2,000, something like that. And that's a couple meals out to dinner. Might be a trip, especially when you got a big family, right? The one dinner could be $500. There's also like cash flow. Determining what your cash flow needs are for the year may determine when you take your requirement of distribution. So if we want to avoid paying capital gains taxes or liquidating stocks because we have to take this money out of our IRA, we may want to do that in January or February so that we can actually utilize that cash for the year. So there's just ways around certain things, if you do a little planning or ask the right questions, that you can potentially save some taxes on.